Welcome everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week we're going to have Sheryl Moore, #1 authority in index universal life and indexed annuities. Today she's going to be talking about all the crediting methods, a very controversial area. Get ready for some serious back and forth controversy. Sheryl will be all over it. Don't forget to watch us today at the Business Insurance Zone. Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, BrokersAlliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Well, our email address here is thebiz@brokersalliance.com, or you can call us at 1-800-290-7226 for any questions or quotes on life insurance, DI, LTC, annuities, and even group pensions. And remember, I'm not a tax advisor or a legal authority, so before moving forward with any of the strategies you hear on our show, always check in with your CPA and attorney first. And if you're a FINRA registered rep, always check in with your compliance department before moving forward with any of the things you hear on our show. Well, today I have our special guest. We had Sheryl on yesterday. I have her right here from Life Specs and Life Annuity. She's the developer, the founder, the creator. She is the diva that is in the industry due diligence area of indexing. Welcome to the show, Sheryl.
Thanks so much, Steve.
Day 2. Now, we had Sheryl on yesterday. If you missed our show, you need to hop back out on our site, either Vimeo, YouTube, Brokers Alliance On Demand, and several other portals that we support. You need to check it out. If you're saying, I need an introduction, instead of reading mind-numbing educational material on this out on the web, I think we had a great show yesterday that introduces indexing. Now today, on our first segment, I want to hop out on the whole issue of indexing. I mean, I was shocked to hear, and I think a lot of our listeners were yesterday, producers. Here we thought we were investing 100% into whatever indices or the split indices that we're using. And truth be told, we're sitting there with 95% U.S. government, investment bonds. I mean, a very small portion of it is going into puts and calls on the annuities.
Absolutely.
Or, I'm sorry, on the index.
On the life insurance contracts.
Yeah, I just want to make sure we understand that, because I think a lot of our producers were taken back. I'm sure the email reflects those kind of questions.
Well, absolutely. But when you think about it, how can we offer a guarantee that the client won't lose any money as a result of market fluctuation if we're directly investing in the index?
Well, you can't. I thought it was some kind of magic show, but
Well, okay. We do work a lot of magic, but we can't make that happen, Steve.
Okay. Well, listen, we're talking about it, and there are a lot of indices, both foreign and domestic, that you can choose from on a lot of these platforms for life insurance using indexing. Mm-hmm. So when I'm looking at this, although now it takes on, after yesterday's show, this takes on a whole new meaning where I'm saying we're actually investing in 90%, 95% of this is in government bonds, right, versus I thought we were totally all in playing an index. But this is why we have these shows. I have people on that actually know what we're talking about. Mm-hmm. And I know that most of our producers now are sitting there buying more E&O after yesterday's show.
Absolutely.
I'm sure. Let's talk about it. I'm looking at, we have a couple variations of the S&P, which is our most popularly known domestic. And so I noticed that like, as we're using Nicola as an example on their spec sheet, mm-hmm, I noticed that there's a difference between the S&P Mid Cap 400, the S&P 500, and I'm wondering, what am I getting or not getting if I had the difference between the two?
Well, Steve, because I'm not a registered rep, I can't explain that to you.
Oh, correct.
I am insurance licensed only. But for anybody who wants an explanation of what any of the indexes are, they can go to lifespecs.com, and we actually have a glossary that explains them all.
Now, when I go out to your site and I want to see the difference of that, it tells me what the definition is,
right,
but does it tell me how they've done? Would I have to still go out to the web and search that?
No, but what's really awesome, since you're speaking about North American, they have a great marketing piece that's called the Periodic Chart of Indices. I don't know if you've ever seen it, but it's just a one-page sheet that shows this rainbow-colored grid that shows historically how have all the different indices, mm-hmm, performed.
And that's Nicola's. By the way, we'll be billing Nicola for that little bit of commercial. Yes. I think they should get that. Now, when we're talking about this, we're looking at, and I just gave you the two S&Ps.
Right.
I didn't talk about anything else. Russell 2000, Dow Jones Average. You're looking at the Russell 2000. Tell me a little about what's Barclay. I mean, that's not a
That's
known...
a bond index. If anybody's familiar with the Lehman Brothers aggregate bond index, Barclays is the one who took over Lehman. So that's the new name for the old Lehman Brothers aggregate bond index.
So I'm actually buying a bond index. Is bond better than playing in the equity side of this equation?
Well, again, because I'm not a registered rep, I can't comment on that. But certainly I think it's commonplace knowledge that bonds don't perform as well as equities in general.
I would just deduct out of her classified, completely top secret, your eyes only statement that I would not be buying that index. I guess I'm not into Barclay. Now, we've just named a few. Russell 2000 is big. Everybody knows that.
Oh, yeah.
A lot of people like to play in that space. Way big, broader index. Picks off a lot of other areas that the 500 is more confined in. I also noticed, though, when we're playing in the space of international markets, I mean, European, the Euro 50, I mean, a lot of people are into Euro Stock 50. They kind of know that.
Yeah, that's become a trend over the past 3 years, is offering international indices on your index life insurance contracts. It's a way to make your product a little more sexy.
So international indexing, for some reason, has a little more sex appeal.
Well, think about it. Over 90% of all premiums on index life are allocated to an S&P 500 index crediting method. Well, how can I make my product less blah? Everybody offers S&P 500, but does everybody offer the Hang Seng?
Well, now, thinking of the Hang Seng, I mean, ING a couple years back scored big. I mean, that number, they have their buckets where you participate in 3 different indices. They get credit you 75 on the first indice, I think it's 25 on the second one, and then they take the last one and they just actually eliminate it.
Yeah.
You don't even have to worry about that.
That's become really popular too, and that originally emerged because of American General's global product. We call that a rainbow crediting method, where you're tracking 3 or more indexes over a period and seeing which one is the best performing, next best, least best, etc. Lots of different insurance companies have come out with their own versions of rainbow crediting methods. Not all of the indexes are the same. Some companies, look at it annually. Some, like Pac Life or American General or ING, are looking at every 5 years or every 3 years. It really depends on the company, but that is kind of a neat way for the producer to say, look, I don't know what the best performing index is, and I'm a little concerned about making sure I make the right choice. So if I choose this multi-index rainbow crediting method, it does the work for me, because it says whatever the best performing is, we're going to put the greatest percentage weighting on that best performing index.
I remember when China was like pedal to the metal, they were growing leaps and bounds. The Hang Seng was just like killing it. Now things are slowing down. They're getting a little slower. We don't know if they're going to retread their economy and put it back on the fast track. We don't know anything. But I guess for rainbow kind of purchasing, I'm kind of spreading my risk to this and getting the best of the best performer and actually eliminating the worst performer. I mean, I kind of like that.
Yeah, and a lot of other agents do too, especially in this heightened regulatory environment. I hear a lot of guys who say, I sold 2 cases, one to the husband, one to the wife, and he chose S&P 500 and she chose NASDAQ 100, and I didn't advise against either one, and he got an awesome gain and she had a loss. How do I explain that to them? Well, this is a nice little way for them to be able to say, look, I don't have to make the decision. I don't have to worry about doing my due diligence and ensuring this index has performed the best historically. But keep in mind, S&P 500, would you say that's the best performing index historically? Heavens no.
No.
But more than 90% of all premiums are allocated to S&P 500 index crediting method on Index 2L.
Now, can I go back to your question? Because you said Nicola puts out, and again, I'm billing them for this. They put out this rainbow spreadsheet. Would that indicate what you just said? Would that actually lay that out and say, oh yeah, the S&P wasn't the player?
Well, let me preface the statement with this. As a former illustration software developer, I'll say past performance is never indicative of future results, Steve. Okay? But we can look at the market historically and draw some conclusions about what future performance may be. And that neat little rainbow periodic chart of indices that North American has, is a nice way to be able to easily analyze, okay, during what periods, during bear markets or bull markets, which indexes have performed the best. And based on today's economy, where do I think I should make my choices for my client's premium allocation?
Well, that's a big heads up. I mean, because of 90% of the money is going into the S&P index, and it isn't the one that's winning most of the time. I mean, that would give me a heads up that I need to start looking at Hang Seng. I mean, the Nikkei 225. I'm looking at this emerging market from Morgan Stanley. I mean, there's a lot of this stuff going on. There's different indices now, and I want to see who's playing. I mean, the world is shrinking, right? And the U.S. economy is now integrated into the global market.
Right.
So if I'm going to look at what do I think of the next 10, 15 years, because I think you need to be in, if you're going to play the indexing on a life chassis, I think you need to be in this for 12, 15 years minimum,
Absolutely.
right, to really make it happen. So I'm going to start being a little bit more choosy and picky on the indexing and not just say, well, America, S&P 500, I'm just doing it.
Well, the only reason S&P 500 is generally the most widely used index is because it's the most widely recognized.
Right.
And when you look at the cost of options on S&P 500 is probably going to be a little bit better than on a Russell 2000.
I would have to say, if you were buying this outside, almost all the time you look at S&P 500 against other indices, it is dirt cheap.
Yeah.
I mean, even in variable universal life, it's 10, 20 cents on M&E.
Well, and keep in mind, these companies have to pay licensing fees to those companies too. And the licensing fees can be pretty expensive. You think about a company like North American who offers 6 different indexes on any one index life insurance product. Think of all the licensing fees that they're paying. Some insurance companies say, look, we can't afford to spend all that money for licensing on 6 different indexes. We're just going to offer S&P 500 only.
Well, I noticed, speaking of Nicole again, and again, I'm billing them, they're one of the few carriers, I can't believe this, they actually have an inverse point-to-point. Basically, these guys are shorting the market using the S&P. I mean, what happened there?
Well, I'll tell you, we've had a few different index life and index annuity products that have used a similar crediting method historically. What this is an annual point-to-point where we're looking at the S&P 500 on January 5th, 2009 and January 5th, 2010. But instead of crediting interest based on a gain in the index, we're actually crediting interest based on a loss.
Wow, we're becoming bear market players on a life insurance chassis. I've lived to see it. How about that? My 30-year career, I've lived to see it. Well, in our next segment, we're going to talk a little bit more about the indexing. We're going to head into the crediting methods. I mean, this is a whole controversy, and I want to cut it off at its knees on this next segment. Listen, you can call us at 1-800-290-7226. When we come back from the commercial break, we're going to talk about the crediting methods, which I think is the big bigaboo. It's going to be problematic, okay? Right after the commercial break, we'll be back with Sheryl.
Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new.
Well, welcome back to the Business Insurance Zone, the talk show that focuses on insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. I want to remind everyone you can watch this show and every show on Vimeo, YouTube, our Facebook account, Twitter, LinkedIn, and the on-demand section in brokersalliance.com. And remember, I'm not a tax or legal advisor, so before moving forward with anything you hear on the show, always check in with your CPA and attorney. And if you're a registered FINRA rep, always check in with your compliance department before moving forward with anything that we talk about on the show. Of course, back with us again, Sheryl Moore, the queen that is all indexing in the country, a national authority, her software package. life specs, and annuity specs, all about indexing. Anything that's indexing is Sheryl Moore's territory. We have the number one authority in the United States on here. We talked on the first segment about indices. Now I want to talk about crediting methods, which here's where I think a lot of gamesmanship is being played. Am I not right?
You're absolutely
okay,
right.
well, we're going to call this segment Game On.
Game On.
Because I want to get down to it and drill down to these numbers. Talk a little bit about, first of all, we're talking about frequency of crediting, the index method itself, right? And then is there that much? There's a lot of press about, like guys are pushing out like, hey, well, I sweep daily, I sweep monthly, I sweep, what is it?
Okay. Well, first of all, let's talk about the crediting methods. Initially, when we had indexed insurance products back in 1997 and they were first being developed, everybody used long-term point-to-point crediting methods. We look at the S&P 500 on January 5th, 1999 and January 5th, 2009, credit interest over that period. Well, there's a problem with that methodology, particularly if you're looking at indexed annuities, because any money that's taken out of the contract in between the beginning point and the end point does not receive indexed interest.
Did people actually know that going in back in the day?
No,
did the
absolutely
agents
not.
know it?
There was a lot of problems with communicating that, and timing of withdrawals was very, very important, but not many people understood it. Today, more people know about it, but the problem is any index is going to have a higher propensity for gains over a long-term period, Steve. And for that reason, the rates are going to look much more attractive on a long-term basis. But do you want to have to explain to your policyholder why every year when they get their annual statement, it shows that they don't have any more interest crediting than they had the year before?
No.
That's a challenge.
Well, now, when they did the annual point-to-point back in the day, if I put my money in and I didn't get credit, I could be sitting in a side account, right? Getting the guaranteed interest of account.
That's where your sweeping comes in.
Yeah, and I was like, wow, I'm not even in the, you mean the whole time, if I don't hit the right point to point,
Right.
I could be sitting in a side fund getting nothing except for the rate.
Well, and people who offered index life initially didn't realize that was such a huge issue. It was more an administrative issue for those companies then, looking at what can our systems handle.
Sure.
We can create an index bucket once a year. Well, that's great, but if you have a client who's paying on a monthly bank draft, that means that for 11 months they're earning fixed interest on an index life insurance product.
But when that came to light, there were a lot of unhappy clients. And this is why we've had, if there is any negative about doing indexing, the things of the past have come to haunt us in some of the way we talk about it today. But that's why we're doing the show. We're trying to clear up these issues. So an annual point to point in the day. Now, is annual point to point different today?
Annual point to point's the same today that it was before.
So I still have the same issues if I'm putting it in. That may not be a good time then, right?
Well, what you're talking about is the timing of the index sweeping. How frequently does the insurance company create buckets? Today, most every carrier does it at least quarterly. Most do it monthly. And we even have some companies that do it daily. So if you have a policyholder that does a monthly bank draft, but let's say they have a 1035 that comes in 2 days after their monthly bank draft premium payment, they're going to create a new index bucket for each of those premium payments.
So actually, they have, by deposit, if this is what I'm hearing you say, that's when the clock starts.
Exactly.
Wow, now that's really different. Have you seen anything in statistics that show a greater advantage at whether it's annual, month-to-month, daily sweeps, and crediting methods?
No, really, I mean, you think about the bottom line here is that index life is going to return 1 to 2% greater interest than a fixed UL. Doesn't matter which crediting method you use, and you really shouldn't use market timing because you're not getting any further ahead by doing that.
And daily averaging is no better.
No, daily averaging isn't better than monthly point-to-point versus annual point-to-point. These are all just a bunch of different calculations that have been created to say, oh, hey, look at me. My rates are more advantageous than this guy's. Well, yeah, but you're using daily averaging, and that guy's using the annual point-to-point. That's not an apples-to-apples comparison. Okay.
But I get using, let's just say, a general rule of thumb. If I was using a indice like the S&P 500, which we're all pretty familiar with, you're saying that it wouldn't matter if it's annual, monthly, or daily averaging. Statistically, there's not much difference here.
Over the life of the contract, there isn't. And that's why, yes, I'll have guys push back and say, that's not true. Because some years you get zero. And I have some clients who got, 43% gain in 1 year over that same period. Yeah, some years you are going to get zero. Some years you are going to get double-digit gains. But over the life of the contract, it's going to average out to be 1 to 2% greater than what fixed UL was earning the day it was issued.
Could I extrapolate by saying the longer I hold the policy and the longer the timeline, these issues become really minuscule.
It's the law of large numbers. Absolutely.
And it sounds like the law of large numbers over a long timeline. The longer that I stretch this timeline out, it sounds like it's going to be almost irrelevant.
Absolutely. But the one thing that is important when you're looking at all the different crediting methods are how do they limit the interest? Because on a monthly point-to-point, they're going to limit the interest on a monthly cap rather than on an annual cap. Or on a long-term point-to-point, like on American General or Pac Life or ING's product, you have to look at what if the client cash surrenders in the middle of that period or takes money out in the middle of that period? Are they going to earn index interest or not? For most companies, they don't credit any prorated index interest.
So it may be, let me just say this, because I just thought about this. I think I might have had an economic epiphany on the show. If I'm in distribution mode now, all right, I've been doing my annual point-to-point or daily or monthly, we said it didn't matter over that long period of time accumulation. But now I'm taking money monthly from my distributions. Now I don't know, mechanically, doesn't that matter now? Shouldn't I be switching to monthly then?
It's based on your preference. What I tell the insurance agent is you talk to the client about the crediting method that you feel most confident. Because the number one question I get asked is, which is the best crediting method? The best crediting method is the one you understand the best and that you can convey most easily to your client.
But in a distribution, you're saying there's no real difference still?
And most people don't reallocate their premiums after the policy's in force.
Even during distribution?
On index life.
Okay,
Absolutely
so
not.
what if we decided to change the planet today, Sheryl, and say, because you're taking distributions on a monthly basis, which almost every illustration will show better than annual, is there a method then that I can dovetail in there? I mean, we need to look at that. I think we need to study that out. We'll be back with that on another show with Sheryl, because to me, that's a new revelation. I don't know if there's a mechanic, or maybe nothing to it, but we need to look at that.
Absolutely.
When I'm looking at the indexing methods and the crediting frequencies back and forth, I mean, I'm trying to combine these to see, is there a better boilerplate? And you're saying basically not that much.
Well, and it really depends on how familiar are you with the market, okay? A monthly point-to-point is actually a very, very widely used index on the annuity side. Not as widely used on the index life side, but that's a crediting method where it takes advantage of a steadily upward rising market. I have index life policyholder annual statements that have received over 40% gain in a 1-year period using monthly point-to-point. However, very few insurance agents use the monthly point-to-point method on index life. They tend to use daily averaging, monthly averaging, or annual point-to-point. Different crediting methods are going to perform differently in different environments. So an annual point-to-point, which only takes point A and point B into consideration, and you don't care about what happens in between, well, that's great for a lot of different markets. But if you take an averaging method, like a monthly averaging, which maybe you've got a market where it's highly volatile and a lot of ups and downs in between, you don't want that because that's going to water down your results.
So if a person's doing dollar cost averaging by monthly contributions of premium into their policy, is there an advantage of going monthly point to point?
No.
None.
No.
Okay. Well, see, this is why I'm trying to demystify.
Sure.
This is another confusing area of indexing on a life insurance platform, especially for accumulation, that boggles the mind. We're all trying to say, well, it's annual, it's monthly, it's daily sweeps, crediting. We're trying to say, well, in the long haul, maybe it doesn't really matter.
Well, because even a monthly point-to-point doesn't credit interest until the end of a 1-year period. So for that reason, there's no advantage over an annual point-to-point per se.
I want to just drop back before we head out to the end of the show today. When I'm thinking about these rates, I want to go back. I'm looking at this, and I mean skewed. It's a lot more in annuities, but in life side, I'm looking at the spread between 65% on a par rate. I want to go back to this because I'm wondering if this makes any difference on what we're talking about in the crediting frequency. On the par rate, I've seen them as low as 65. I don't know, maybe there's even lower ones.
Oh, there's much lower. We have some that are as low as 10 right now.
10% participation?
But it depends on what your crediting method is too, Steve.
So that's why I'm saying I'm trying to dovetail the participation rate into the crediting rate, crediting frequency. If I'm sitting there with what did you say, 10%? Wow.
Well, we have carriers that are illustrating rates of only 3.4% right now on index life.
Well, you might as well go current assumption UL.
There you go.
You might as well buy whole life par.
Exactly. But those products that I'm talking about are products that have very high floors, strong guarantees, and so they have less potential for indexed upside crediting.
I guess if I was going to say, if I can't play, I would guess, and again, don't hold me to this, but 6%. I mean, I would say if you're not willing to do 6%, why am I doing indexing?
Right. And, when you look at the charges in the contract and how it's going to perform on a guaranteed and non-guaranteed basis, you need to consider that index life illustrations show a non-guaranteed current that's very, very advantageous and probably not likely to come to fruition. I even encourage agents to use a midpoint illustration when looking at index life because the guaranteed column is going to show worst case scenario as terms of interest and charges. The current side is going to show best case scenario. Well, what happens in between? You know, I'm not going to count on the fact that the S&P 500 is going to return 10% or greater every single year, but I also don't think my client's going to get zero every year.
Well, when we get into our show tomorrow, we're going to talk about this whole thing about look backs and, the credit, what illustrations. I'll talk about it tomorrow, but I call it vapor on paper. So, so I like your thing. So when you're illustrating, we're going to do the guarantees are already the worst scenario, and it looks pathetic because we're doing, maximum charges for COIs, whatever the minimum guaranteed interest. Contractual interest against whatever I put in there, 8% or whatever my numbers are. I like what you said in our show yesterday when you said, yeah, but the actual interest, index is going to be about 2 points above whatever the current interest crediting rate is on current assumption UL. Right. Give or take a little bit. I'm not holding you to it, but I'm just saying when I kind of see that number, I say, okay, maybe I ought to shoot for that as my midpoint. So from now on, when I'm thinking, well, what should be the midpoint on my illustration? Well, what's the current UL market at? Add 2 points and call it a day.
There you go.
Is that a rule of thumb?
Absolutely. Okay. Absolutely. That's a good rule of thumb.
Okay. And by the way, we're copywriting that rule. So anybody's, when we do our article, joint article for producers, whatever we do, or insurance news ad, whatever, we said need to put that in there. Because this participation rate, back into this whole thing we're talking about in crediting and frequency and index method. If I'm looking at, I'm just thinking like, wow, I thought 65 was low. You said 10, but there's some out on the other side of the fence too. At what?
140.
140.
Right.
Par rate. When I think of 140%, I'm thinking major league markup. But again, it's all skewed to the numbers and everything else. Well, I wish we had more time for today's show. We got to go. We got to close out the show. But tomorrow we're going to get into this whole idea. And I want to be able to give everybody a heads up. This is tomorrow will be our last show on the life side. We're going to get into the annuity side Thursday and Friday. Remember, you can write us at thebiz@brokersalliance.com. Call us toll free at 1-800-290-7226 or hop out to our website at www.brokersalliance.com. I'm Steve Savant. You've been listening to the Business Insurance Zone. Well, that's the buzz on the biz for today. Get in the zone. The Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.